Hello, everyone. A very warm welcome to all the viewers. Welcome back to yet another exciting episode of the Fisdom Wealthcast. Like promised last time, this time around, we are back with yet another very interesting episode of the Fisdom Wealthcast with an equally interesting guest with us today. We have Mr. Neelesh Dhamnaskar, who is the fund manager at Invesco India Mutual Fund. So, Neelesh, a very warm welcome to the Fisdom Wealthcast.
Yeah, thanks, Nirav, and pleasure to be here. Thank
So,
you.
Nilesh, without any further ado, I am going to ask the quintessential question that is always on top of everyone's mind, and this is something that I start all my webcasts with. Market क्या बोलता है? How do you see the domestic market shaping up? How do you see it reacting to various developing economics and scenarios today?
Sure. So thanks, Nirav, once again, and warm good evening to everyone. Just to start off with a very relevant question, which is how we see the markets. Just to give you a perspective, post May, basically, when we came last year, when we came out of the first wave, and things really came back very well with respect to the economy. Companies' profits started growing up very well, and it was chugging along quite well till I would say April, when the second wave hit us. During that time, there was an initial scare, I would say, for a month or so, because I mean the kind of COVID daily COVID cases went up quite sharply. But good thing is, within about 1.5 months down the line, I think things again have started getting under control. So currently, the daily caseloads are have fallen to just 10% of the peak. More importantly, the vaccination programs have also been parallelly happening at a reasonable pace, I would say. Currently, about 25% of India's population has already got at least one dose. Okay, and the pace of vaccination continues to accelerate, which bodes well overall. Coming to resultantly, what has happened is a lot of the large state governments have already started opening up that way. I mean, they have issued guidelines wherein, I mean, back to normal. I mean, the journey towards back to normal, they have started off, which again will be helpful in the overall in terms of overall economic recovery, which had got stopped in between, I would say. Coming to the company's profits, now this is one very important aspect. Ultimately, the stock markets are linked to companies' profits or their cash flows. Now, on this front, the Indian companies have done extremely well. Have done extremely well over the last 2-3 quarters. In fact, just to give you a sense, in FY21, which was a COVID hit year, the profits, the Nifty companies, their profits increased by 15%, which is like difficult to fathom. Maybe 9 months back. Okay, so the companies have really cut costs. They have streamlined their operations, done all the right things, and also gained market share from some of the smaller unorganized segments. And resultantly, the profit cycle for the companies has been very resilient. What we believe is that this year, because of the second wave, the profits growth would be relatively lesser than what we were expecting earlier for FY22. But it still has a low base, and the earning growth will be still very strong, and it should further accelerate as we go into 23, and it can extend beyond if the other things also fall in place. So that's on the earnings. Coming to valuation, yes, valuation is is one area where things have gone slightly above. I mean, I would say, if one were to look at the Nifty valuations, they are trading much above the historic means. Certainly, not something which one would like. But having said that, one should also keep in mind that we just recovered from a COVID hit year. Okay, and so resultantly, the near term estimates also are not commensurate what the companies can actually deliver. I mean, they have the capacities, they have the capacities, everything is there. Just the demand has to come. So I would say valuation is not in a best zone, but not in a crazy zone either. Okay, and maybe just one or two line on maybe what we are seeing is slightly on the broader markets, some degree of frothiness is visible. But and I think that that is one area where one needs to be cautious about. So overall, what we would see, what we believe is that the market is very evenly balanced, and the risk reward from here on is fairly evenly balanced. And I think now all will depend on your stock selection and the earnings growth, which the companies, or the earnings surprises which the companies would deliver from here on. Yeah,
Right.
thanks.
Absolutely, very well put. So, if I were to sum it in a line, I would say that the markets have just started heating up, and there is, although there's some heat in terms of valuation, there's still a lot of steam to go. Right? If one is wise and prudent with his or her allocations and selections, there is still significant upside in the market from here on. Obviously, we are well ahead of the difficult times that we had seen in the recent past, and but not quite in the best period that could have ever been. That is still ahead of us. So, what a wonderful time to be invested into the markets. And while we're talking about domestic markets, one another topic of wide interest is international investing. So before we jump into international investing and take a deeper dive, why don't you give us a high level view of how are global economies developing at this point in time, especially the developed ones, which most of us are tracking.
Sure, sure. Yeah, which is a very relevant point. Just to give you a sense on the global picture, see the two large engines of the globe, which is US and China. I think they are reasonably doing well, I would say. First, if I were to talk about USA, USA is in probably in the doing the best. I mean, it's I would say because of these fiscal stimulus measures, large fiscal stimulus measures which the government has enacted over there, the monetary policies which continue to be very conducive, as well as which has translated into a lot of money flowing through into the hands of consumers, and resultantly the consumer sentiment is quite high, and people are spending. Parallelly, the vaccination also is happening at a good pace. I think in US, if I recollect correctly, about 50 to 60% of the people of the population has already got vaccinated. So on the whole, US is in the best shape, and in a good position. Coming to the second big economy, which is China. Now China, actually, good thing about China is though they were, I mean, COVID came from there, but they were like very adept at controlling COVID at the right stage. So their economy didn't really got damaged to that extent as some of the other economies got into last year. So resultantly, they are growing at their own pace, and they have become slightly more inward looking, but with their policy measures, and they continue to do well, and the consumption related and the activity levels continue to be pretty good in China. Coming to the other two zones, if I were to split simply the Europe and the maybe the rest of emerging markets, I mean the so Europe relative to I would say Europe is still catching up. It is nowhere near the shape which US has reached. I think over there also the vaccination programs are on, but I think in terms of the overall activity indicators, the overall consumer sentiment, there are still some time away to reach US levels. And lastly, emerging markets, including India, I mean they it's a mixed bag. I would not be able to give you a generic answer, but I would say in terms of ordering, US followed by China, followed by Europe, and followed by the emerging market. That's the way from strength to weakness is what the overall these zones are into at this juncture.
Lovely. I absolutely love the coverage, the zone wise coverage that you shared. And this reminds me of a very, popular misnomer among the investor community, especially the ones who are just starting off. Quite often the not investors tend to liken global investing as a theme to investing in US alone.
Right.
So US investing is almost synonymous to global investing, but we know there's
That's
a
right.
world beyond US as well, right? So why is it so that we are observing this among investors, and how would you like investors to perceive global investing? Is it, or is it just because there are limited opportunities available, or there is a horizon that is not really visible to the investor at this point in time?
Got it. Yeah, a very relevant question. Most of the investors investing overseas is like US based, but having said that, it is not the case. I would say, yes, US being a very large market. In terms of market capitalization, they are they are the largest economy. I mean, for that matter, and obviously in terms of market capitalization, they're the largest. But it's not that the other countries don't offer investable names for domestic investors now. But what has happened, to answer your question, is that over the last few years, certain sectors like the tech sector has particularly done very well, and tech for a major purpose, for all practical purposes, because US has been the major hub for techno they have been at the forefront of technological innovation. So resultantly, the lot of the value creation has happened in that space, particularly where we see the Nasdaq. A lot of companies which have done well are a part of Nasdaq, and those companies have done well, and resultantly, those so you it has been more US centric. But now, but having said that, if one were to see it now, yes, no doubt, some of the companies within that, within the Nasdaq 100, or some of the US centric companies, they have done well. They continue to do well. They have good prospects, but parallelly, one should not forget that there are opportunities in the other consumer oriented spaces, which may not necessarily be listed in US. So just to give you an example, now we all know that Alphabet, which owns Google, they are listed out of US, and search is a integral part of going digital. Okay, we whenever we go on net, we try to search via Google, but then there are countries where the outside competition is not allowed, for example Russia or China. So now, so Russia is also fairly large sized economy, but over there, search is equally used. Okay, but the leader out there is Yandex. Okay, but Yandex is not listed in US. It is listed in Russia, but equally strong, not equally, but fairly strong, 40-50% market share. So but for somebody who is investing for the same theme, may not probably, he has to go to Russia. Okay, he can get the same thing, but not necessarily US. So similar, there are a lot many examples I would quote for similar things in other countries. So what the main point is that it's not necessary that US only gives you the same flavor for these tech industries, and over and above that, there are a lot of other industries, in the non-tech industries, I would say, which equally have good risk rewards. I would say some of them, which are beyond US, and in some other countries or other sectors also. Yeah,
Right. Absolutely. So as long as we are in the line of talking about international investing, and the entire theme of global investing, uh, for a normal investor, I speak on behalf of several first time investors. Global investing, the biggest merit that global investing presents to an investor is the ability to diversify beyond a certain geography, to diversify beyond India per se, right? So, what are the other benefits? What is the incremental value add that international investing can add as an allocation to your current portfolio? And perhaps you could throw some color on what are the risks that one should understand while venturing into international investing.
sure. Yeah, so as you rightly mentioned, first reason for international investing is diversification. As you all know that, all the countries, no, not all countries are. do the same way at every point of time. I mean, one country is growing very fast, the other country may not be doing, maybe growing at a slow rate. So that way, I would say diversification is one of the primary benefits for overseas investing. Okay. The second important reason for investing globally is low correlation. See, though the equity markets that way are linked eventually, but they are not correlated in a one is to one. So for example, so maybe countries economy is doing well, resultantly that country's stock markets, equity markets will do well, but the other countries are not doing that well, and consequently the stock market may be a bit tepid. But what and it may happen vice versa also. So what happens is, when you invest globally, in overseas, when you take international exposure, the overall returns get smoothened, and the volatility also goes down, because of this very aspect which I spoke to you about. And the third most important reason for investing globally is basically exposure to businesses which are not available in India. Now, this is by far the most important reason. Uh, Maybe I'll explain this to you with some example. Now, as we all know that we over the last few years, we all have been using Netflix for our to fulfill our entertainment needs. We have been using Amazon to buy stuff online. Okay. Then Facebook is one area where we spend so much time on. I mean, the entire family. So is the case with gaming. Increasingly, a lot of people play games either on their PlayStations or on their laptops, or even for that matter, mobiles. And there are companies out there who are kind of benefiting from that. But unfortunately, the none of these companies, some of the examples which I just gave you, are listed in India. Now, for example, Amazon is listed in US. Then you got Netflix again listed in US. Prominent OTT. Facebook is listed in US. um, the mobile gaming company which owns basically Candy Crush is something which we all play. The Activision Blizzard is listed in US. Okay, again. So what I mean to say is, the companies are making revenues, they are making profits, but we as Indian users are not being able um, to capture that as investors. So one way, and mind you, these companies have very large India businesses. Okay, not just global businesses, India businesses also. So one way to circumvent that is to invest in these companies. And the one way to invest in those companies is you directly buy shares on their exchanges, which is a bit cumbersome and a lot of hassles are there, compliance hassles, tax hassles. Or the other way is you buy into funds which have invested in these names. So this is one reason. And parallelly, I would say one more tangential point I would like to mention is, see, a lot of the companies, I mean, new tech companies recently got are getting listed in India, but their equivalents, okay, are already listed in US, which are available at much more reasonable valuations. A case in point I can tell you is that for gaming. Now, gaming, recently, in India, the first gaming company got listed, Nazara Technologies, and when I see their valuation, they are at a much higher valuation as compared to the valuation of very dominant and very stable companies, gaming companies, in US. So I would say, I mean, you get a good flavor of the same themes at a much more reasonable valuations by investing in global markets rather than just sticking to India. Yeah.
Right. So you spoke about some very interesting consumption patterns. Okay, you briefly touched upon a few interesting consumption patterns. I remember you spoke about Google. You gave the example of Google and Yandex, and over a period in time, the shift in consumer behavior and patterns sort of defines the success of certain businesses. For instance, I doubt if anyone says, why don't you do an internet search? But I quite often hear people say, Google kar
Right.
le isko, right?
Yeah. Yeah.
So
Right.
that consumer trends are a primary indicator of what
Hmm.
lies ahead for respective businesses and companies. So why don't
Correct.
you throw some light on what are the key shifts in consumer behavioral patterns that you are observing today? This could be at a global scale. Globally, what are the shifts in consumer behavior that you're observing today?
Yes. So, yeah, very relevant question, which is, what are the the secular trends which we are seeing in consumption patterns? So, before getting into that, let me just brief you about the fact that why are these changing? So, see, over the last, I would say, 7 8 years, there are two three powerful forces which have taken off, which have resulted into certain changes in consumer patterns which are here to stay. Now, what are these? Firstly, the internet penetration has been increasing by leaps and bounds over the last few years, because most of the people are getting connected to internet not via their PCs but via their mobiles, and not just via their regular mobiles, but via their smartphones. Now, what this has done is that it has thrown open it has thrown out the number of consumers with internet access via smartphones. Okay, that has increased by leaps and bounds. Now, and there have been companies which have modified their business models or to kind of fit into this digital ecosystem, so as to speak, and those companies are benefiting. So the point is, the third point, the third important powerful force which I was talking about is the demographics, which is, anyway, demographics means the every set of the younger consumers, I would say, younger consumers have a different set of preferences and consumption patterns as compared to their predecessors. So I would say that also reflects in a unique set of consumption patterns at an aggregate level, which leads to some companies doing better versus some companies not that. So now, coming to back to these themes, and maybe let me explain this to you in a slightly more, maybe with some examples. So what because of these three powerful forces which I spoke to you about, what we are seeing is, globally, a lot is changing, and it basically, a lot of aspects which we do, I mean, they are changing. I mean, we are doing things far more digitally as compared to the more brick and mortar way of doing it earlier. Now, just to give you an example, earlier, to kind of be connected with our friends, we used to um, we used to go to their homes, or use a mobile phone to call them up. But nowadays it is via Facebook, WhatsApp, okay, which is one way. Similarly, entertainment, as I've already given the example of Netflix. OTT apps are increasingly taking away share from the regular TV and the other mediums of entertainment. Similarly, you've got e-com, the biggest. I mean, earlier we were simply going to the local kirana store and buying stuff, or going to the mall to buy stuff, which was a bit inconvenient. But now, we all are getting used to buying stuff online. I mean, we just simply order it online. It's convenient, as well as there are good amount of discounts. Okay, so resultantly, what is happening is, we are gravitating towards a more digital lifestyle. Okay, and this is where I would say, the change is happening. So this change, I would say, is getting reflected about in um, 5 6 areas, if I were to see. So one, e-com is one I've already spoken about. Then another aspect is gaming. Now, gaming is something which is also taken off in the recent years, because earlier games were played through CDs, okay, on PlayStations or computers through CDs. Now they're directly getting downloaded on their PlayStations and being played. So it has opened up, the addressable market has increased. More importantly, mobiles. Now, earlier the games were played only on PCs and PlayStations of the world, because they require high graphic processing capabilities. But now the mobile phones have good graphic processing capabilities, wherein a reasonably high end game can be played on mobiles. And increasingly, a lot of gaming market is shifting to to the mobile, and it has kind of increased the addressable market by almost 5x. So these are few areas where these things are changing, and it is imperative for, and the companies who are operating in this field are completely different from the regular companies. I mean, on the other side of the situation, the regular brick and mortar companies in these same spaces are have been their market shares have been reducing. So the main point out here I want to drive down to is that one has to ensure that as investors we capitalize on these trends and be with companies which are benefiting from these trends, right? Yeah.
Right. So while you were giving quite a relatable example, I couldn't help but hit a little bit of nostalgia here. When we were young, we used to go to a certain place called as a cyber cafe to play
Yeah.
games.
Correct.
And the guy would load on a CD, and we would play paper R sort of a situation. But today with the games, I feel वक्त बदल गया है, but लोग वही है, बच्चे तो वही है.
Yeah.
They still want to play, but now they have access to all of it on their phone itself. So
Yeah.
like you rightly said, the market has obviously expanded, the accessibility has improved phenomenally. The entire shift in consumption pattern is evident. I don't think it requires a generational shift. Today, the way the world is going, consumption pattern is shifting and changing as quickly as years, months, and dates. As simple as I feel we'll hit an era of pre-COVID, post-COVID. Wherein pre-COVID we would be having this conversation in person, but today we are having it on such a
Certainly.
nice video conferencing solution. So Nilesh, it is quite amazing how Indian consumers, thinking about it, the irony, or not quite an irony, but the situation at hand. Indian consumers have access to global products and services today,
Hmm.
but somehow Indian investors don't have access to the same companies in terms of stocks, right? And that is
Right.
amusing and a little disheartening. More from an investor standpoint, it always makes sense. If I know that I spend a lot of time and efforts and resources on companies like Amazon, Microsoft, Netflix, PlayStation, Nvidia, such global companies, I would definitely want to own a piece of it. I want to participate in their growth story. And there are not many options available, which reminds me, you run one of the most successful global thematic funds that are out here in the
Right.
industry. It is known as Invesco India Consumer Trends Fund of Fund, right?
Global.
Which majorly, the global consumer
Hmm.
trends. So it majorly revolves around investing in this very theme that we have been talking about. So why don't you throw
Yes.
some light on what differentiates this product from other mainstream international based FOFs? What makes this stand out, and how does it add more value to existing portfolios for investors?
Sure. Sure. Yeah. So before maybe touching upon that, let me talk about a little bit about what this fund is all about. Before I mean talking about how it is different from other some of the other competing funds. Okay. So first of all, what we have offered in India to the local investors is the feeder fund of this Invesco Global Consumer Trends Fund. This underlying fund has been in existence in the last 24 years. Okay, it has a long history of being it has a long history in that sense. And currently the size of the underlying fund is about $7 billion. Locally the AUM is about 700 crores, in the sense the for the feeder fund. More importantly, the unique, I mean talking about the what's the core philosophy of this fund. See, this fund basically invests in a very focused set of consumer oriented companies, and the preferences towards selecting companies which are benefiting from some of these secular global trends which I spoke to you about earlier. So now, what it does simply is the I mean, which are the kind of companies which typically get into this fund? So we ask ourselves two questions, that where are the consumers spending their time on, and where are the consumers spending their money on? Okay, so these are one of the important starting points to select or to go about selecting a company. Once the company is shortlisted, then obviously other analysis is done, valuations are looked upon, and then finally the stock is decided whether to be bought or not. So so this is the core philosophy. Another parallel thing with respect to this fund is that it tries to select companies which are capturing these trends, not just in one country but parallelly in other countries also. For example, the rising penetration of e-commerce while buying purchasing things. Now that is this it's happening in US, it's happening in Canada, it's happening in Australia, it's happening in India. So can we buy a company which by buying that company, it gives you a flavor of all the other economies where the same thing is happening. So that's another you can say filter which is set for a company to be bought into this fund. So that's a broad construct. Now coming to the current positioning of this fund, so typically what we have tried to do is about 65 to 70% of the portfolio of this fund is into these companies, this set of companies which are benefiting from this digital lifestyle, okay, which I just spoke to you about, because of internet penetration and people doing stuff more on the digital side rather than the regular way. So 70% of the portfolio companies are in these new age businesses, okay, benefiting from the digital, increasing digital lifestyle. And but at the same time, it has about 30-35% of the portfolio with an exposure to regular traditional consumption oriented companies, more I would say, uh, 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 not necessarily getting disrupted though, but companies like which are strong companies, good brands, but available at a much more reasonable valuations, and they would benefit from the reopening or the normalization of the economy. So it's a good mix of secular plays, 70% secular. What I mean by secular is the trends which these companies are benefiting from, they will extend over 3 years, 5 years, 7 years, 10 years. It's not cyclical. But the remaining 30-35, yeah, they are benefiting from cyclically favorable trends which may ease out after some time. So now maybe I'll be able to explain, let me kind of explain you this with some examples. So maybe the so 70-30 is a broad mix. Coming to what are the broad components of this fund. So the e-commerce is the largest component of this fund. E-commerce, for people probably who are not aware, e-commerce is buying and selling stuff online. Okay, so what we do on Amazon or Flipkart. So now in e-com, within e-com, we own companies like Amazon. Okay, then we own the top two companies, e-com companies in China, which is JD.com and Alibaba. We own a company, a Singapore listed company named C Limited, which is a large e-com platform based out of Southeast Asia. Okay, as well as it's into gaming. So then we have a company named Farfetch, which is again a very a dominant company in the luxury e-com, which is a space Amazon has not been able to penetrate into. So e-com is one space. About 30% of the fund is into that. Then after that comes the restaurants and experiences, restaurants and casinos, which are more, I would say, cyclical beneficiaries. Okay, so what they form about 24% of the fund. So what we own over here are companies like quick service restaurant chains, or regional casinos, okay, based out of US, or multiplexes, or theme parks, okay, and restaurant chains. Okay, so now these companies, businesses have been bruised, I would say, because of COVID, but they are available at very reasonable valuations, and as the economy recovers and normalizes, these companies will do well and accordingly benefit. So this is the second basket. The third important basket for us is video games and entertainment software. Now this basket currently is about 10%, but it used to be as high as like 30%. I remember 2 years back. So this basket, we own the prominent globally well-known gaming companies like Activision Blizzard, which are the makers of Call of Duty game, which is a very popular game within I mean played throughout the world. They also own the Candy Crush, which we spoke about. Then we own EA Sports, another company which is known for making sports-oriented games. Okay. Then Nintendo, another company which probably a lot of us would have played games with. I mean, on some different platform, but they're very good family-friendly characters they have, and which are now increasingly made into mobile games and being monetized. So we have about 4 5 names on the gaming side over here, and gaming has played a good role in giving us positive attribution over the years. The third fourth important bucket is vehicles and automated driving, something to do with auto and mobility. So that forms about 10%. So over here we own another obvious beneficiaries over here, which is shared mobility. Uber we own, Lyft we own. I mean, this is another thing which we have been becoming it's becoming a very integral part of our lives. I mean, driving via Uber or Ola. So these two companies which we own, we also own basically auto retailers. Okay, digital auto retailers. I mean, auto cars be over at one point of time only being sold via dealership, but now they're also getting sold via digital medium. So that is one company which benefits from that. And we also own a few of the companies which are into ADAS technologies or autonomous driving technologies, which also are a thing of a future, and it will play out over the next few years. The fifth important basket is the internet and social media companies. Over here, we own the obvious beneficiaries, which is Facebook, then Alphabet.com, which owns Google, then Match.com, which is a basically online dating platform, which is increasingly becoming more and more socially acceptable globally. Yandex, I spoke to you about, and likes of them. In media, we own Netflix, Sony. Sony is both into gaming as well as into music, streaming music, or giving music rights to streaming music app companies. Okay, so these are the few names in the this basket, and maybe talk about a few active lifestyle. One area where on the demographics. See, I spoke to you about the third important powerful force is demographics. Now, in demographics, the newer generation is more into active lifestyle, more into outdoor activities. So there are the apparel wear, or they want to own is completely different from the regular apparel wear. So we own some Wolverine Worldwide is one company which is into outdoor shoes and outdoor activity related stuff. So a few examples on that. So and maybe last point, maybe again a relevant point is which is the US durables and home improvement. Now this sector has been doing very well in US because US over the last few years is is going through a huge housing boom. Okay, recently a lot of houses are being built, they are being renovated, so a lot of material is required, and we own retailers who provide these materials. So this is just to give you a broad flavor of what the philosophy is and the color on what we own, okay, under various buckets. Now coming to the question on how it is different from some of the other alternatives. So as compared to the first question, which I remember you had asked me, that is it similar to US investing? So one of the prominent areas where it gets compared to is the US based passive funds, I would say. So Nasdaq 100 is one such fund with which at a broader level it competes with. But our fund is very different. Despite we do own some of the tech oriented companies, but the overlap is just 17%. Okay, so we over and above these US centric tech centric funds, we have a lot many other things for their own strengths, and that forms a large part of the portfolio. The second thing is our fund can invest in any place globally. I mean, it is not restricted to US or any regions, which is the case for some of the large funds in this category. So recently we own Yandex, we own a German company. Nintendo again is owned in through the Japanese stock exchanges. So again, it can straddle through across the globe. The third is this fund has about 70 plus names in the portfolio, which is a fairly diversified fund, and which may not be the case for some of the concentrated alternatives. I mean, funds which have some concentrated holdings. So again, that is one area where it is different. And one of the major areas our fund is different, I would say, is from the fact that our fund have a lot of good proportion of mid and small cap companies, as compared to some of these Nasdaq has a lot of these mega caps. Okay, so we have a lot of these mid and small cap companies by the US standards. Okay, US mid and small cap definition is like $2 billion and above market cap. Okay, they are fairly large. So this is where the alpha also gets generated from, and resultantly we there's a alpha generation potential from our fund is slightly more higher as compared to some of the passive fund or large cap oriented global funds. Yeah, so I think these are the broad, I would say, differentiators between our fund and some of the competing funds which are available in on the overseas fund or fund category. Yeah,
So Nilesh, I'm in complete appreciation of what Invesco is trying to do here, right? I see the merit in such a product. I understand why such a product exists, how it is positioned, and what purpose does it aim to solve, right, within a portfolio. In complete
yeah,
appreciation of that. However, there is one lingering doubt that I had all through this, all this while, was that. The thing about consumption, right, it follows a certain trend. It's not
yeah,
just consumption, sorry, I'm talking more about
mm,
consumer trends majorly. So
yeah,
the thing about consumer trends is it is secular till the time it is secular, and then
yes,
an event happens, and then things change, life changes, right? So at the same time, we over the past couple of years we saw this particular secular trend in consumer patterns, and then there
uh
was a certain shift in consumer patterns that was led by this entire pandemic. Okay,
yeah,
so
yeah,
so
yeah.
so how did this fund actually navigate the dislocations that this pandemic would have caused in the broader trend?
Right. Yeah, this is a very again a relevant point. I should have in fact brought it out while giving you the areas where we differ from other funds. In fact, since this is an actively managed fund, so the what we have been doing is we have since and the fact that last 1.5 years have been there have been so many dislocations because of COVID. We have used these dislocations to our advantage. I think the active management, so as to speak. So just to give you an example, since we have a lot of digital lifestyle oriented companies. So when the COVID struck, okay, people had nothing to do, but they people meaning consumers. I mean, they could do whatever they could do at home, which is I mean, use Netflix, order things from Amazon, play games. Okay, so we had loads and loads of that in our portfolio. So and those stocks did very well. I mean, that portion of the portfolio did extremely well. But what we didn't just felt happy about when COVID struck, maybe in April, May last year. What we did is these companies did well, but on the other side, the regular brick and mortar consumption companies, okay, like restaurants or multiplexes and those, their share prices got hammered as if they were going to close down in a year or so. So what we did is we rebalanced our portfolio. We harvested we sold off some of the positions in gaming and some of the other profitable positions, and harvested them into some of these step 2 beneficiaries or step 3 beneficiaries, we would say. And which subsequently, I think, as things started normalizing about 3 4 5 months down the line, I mean, their stocks did extremely well and contributed to the portfolio returns. So this is what I would wanted to highlight, that the active management has helped us. The secondly, um, another area is we have been able to take bets early on, large bets, like for example, the regional casinos. Okay, another area where we have a good presence in. Over there in US, a lot of states are allowing online gambling and sports betting. So what we did is, when that process was on, we started taking good positions in a lot of these companies. Penn National Gaming is one such company, then Caesars Entertainment, another company. And those stocks, I mean, the performance of the stocks have been extremely well, and they are not part of any benchmarks. So the point was, the active management and the rebalancing at appropriate times to capture where the risk reward is best. I think that has helped us a lot, and that increased our churn during COVID, the last 1.5 years, but it has contributed a lot to the overall portfolio returns. Yeah.
Right. So, Nilesh, that was a wonderful explanation. This brings us towards the fag end of the section. There are quite a number of questions that have come up from our viewers. We'd like to pick a few and hear your thoughts on it. Uh, so there's a question around whether this fund has any. Okay, just let me read it out. So, how do you guys research about the company for your global consumer fund? I'm sure you already touched about around it, but I feel this is more around the framework, the stock selection framework that is in exercise.
Right, right. Yeah, so we have a large team, or US growth team, basically. Okay, which evaluates a lot of ideas across various regions. They are supported by the analysts. I would say they are a fairly large team. This particular team comprises of four people, and they get help from various regional analysts and within Invesco, as well as sell side. So they have a good support system, and they have very well defined philosophy of pruning out companies which don't come out of which don't adhere to those criterias which I spoke to you about. And another one aspect is which is critical, which has helped us a lot, is whichever companies which we own, we understand the ins and outs of that. I mean, the companies, I mean, the team, the core team members are like more than 20 years plus experience, so they know the companies very well, they know the management, so their understanding of those sectors and the companies are very well, which probably helps in capitalizing on the opportunities as and when they arise. So yeah,
Right.
this is, yeah.
Right. So there is yet another question, a simple one, but I'm sure many are wondering what percentage of equity should one diversify into international funds?
Yeah. So see, the general, so what our take on that is, international investing probably should probably one should have about 10 to 15% of their equity allocation one can have towards overseas equity funds. See, being a domestic investor, the home country bias is always there, but at minimum 10-15% I think is a good starting point. If however, if there are certain investors with slightly more risk appetite, they can have a slightly higher appetite. And secondly, for some investors who would at some point of time have a foreign exchange related expense going forward, so for example, if one were to their kids are expected planning to go abroad for higher studies, I mean, they can probably allocate slightly more, because at the end of the day, these are dollar assets. I mean, at least talking about our fund. So tomorrow, so that kind of the currency depreciation gets hedged out. So yeah, that's the overall our take on the allocation.
Right. What's quite amusing is that the next question is perhaps coming from the end of the spectrum on which this question was. So I'm just going to read it out. So, if India is slated to lead the global economic recovery and has a high potential to generate high alpha, vis-a-vis
Mhm.
the situation in developed nations like US, where they've reached a point where passive is the best bet, will
Mhm.
international funds effectively diversify or essentially dilute the performance of our portfolios?
Yeah, a very a good question in sense, and there are no easy answers to that, honestly. But all I can say is, Yes, I mean the alpha generation potential to that extent in developed markets relatively increasingly will get reduced. Relatively, India is better off, but this is where I think while selecting the overseas funds, I mean, if one were to take an active one, then I mean, maybe one should look at more. I would say market cap agnostic rather than the large cap dominated funds. I mean, this is where, so simply put, the fund which the Invesco Global Consumer Trends Fund, that has a lot of mid cap and small cap companies where, again, though by US standards, they have a large potential alpha creation opportunity. And having said this, the best, I mean, or one way to see whether alpha has got generated is to see the past returns. Now, past return wise, if you see the returns of this fund vis-a-vis its own benchmark, which is the global consumer, the MSCI Consumer Discretionary Index, it has created about 4-5% alpha over the last 10 years, okay, on a CAGR basis. So opportunities are there. I mean, in various countries, and stock selection plays an important role. And if you really notice our fund, it is, yes, theme based, it's there, but ultimately it boils down to stock selection, which the fund has been and rebalancing, which the fund has consistently been doing, and I think hopefully it will continue to do that way. Yeah.
Absolutely. Perfect. I hope this answers the question. A very good question, by the way, whoever has asked this. So
Yeah.
the next question, I will take the liberty to answer it because it is, how can we buy this fund? Download the Fisdom app. Okay. So I had to pick this question. So download the
Fine.
Fisdom app. It is available on the Fisdom app. Feel free, just search and you'll find this fund there. So Nilesh, towards the end, one last question for you.
Mhm.
Given such a wide array of geographies covered in the global consumer fund, will the
Mhm.
forex risk be more pronounced than single geography international funds like US based funds?
No, so see, the way to look at it is this way. See, when they invest, okay, so the fund does have inherent, I mean, currency risk whenever they invest in some of the non-US centric countries, right? But what I've seen is it kind of evens out since I've been an analyst. Maybe just a technical answer to it. Whenever the country's currency depreciates, their I mean, the economies also, the competitiveness increases. Their financially, their numbers also get inflated or deflated, and it kind of evens out for at the fund level, I would say. But for the domestic investor, the important point is, or I mean, is what happens to the USD INR movement, which nobody can surely tell what directionally going forward what can happen. But at least from the past, what we have observed is, if the inflation differential between India and US market remains high, the currencies tend to depreciate to that extent. So if that were to continue, then the it may play out that way. But otherwise, I think the invest the for at the fund level, it gets evened out, I would say. Yeah.
Right, right. So this brings us towards the close of this conversation. But before we close, I have to ask you if you have any concluding remarks or any thoughts that you would like to leave our viewers with over the weekend
Yeah.
to mull over.
Sure, sure. So what the maybe we have, I think, touched upon most of the points which were important enough. See, what we believe is that a combination of say India centric equity investments plus well chosen overseas funds. I think that has a potential to kind of enhance the overall risk return profile of the fund. I mean, overall it will reduce the volatility of you at the portfolio level, and it at the same time it gives you opportunities to invest in companies which are doing well, which are not available to you, right? So, and again, in terms of allocation, to start off with 10-15% is a good enough allocation. And I think maybe as you get more confident, everyone can tweak around that with time and with due course. So I think, yeah, that's all I would like to add.
Thanks a lot, Nilesh. This has been an extremely insightful conversation. I hope the viewers were taking notes. You have shared some very valuable insights around a variety of subtopics per se. So, thanks a lot, Nilesh, for taking out time and sharing your opinions and perspectives. I'm sure it's going to help all our viewers and investors make much better, much informed decisions, at least when it comes to international investing. So, thanks a lot, Nilesh, for your
Yeah,
time and presence.
sure. Thanks, Nirav, for having me here. It was a pleasure interacting with you. Thank you.
Thank you. So, guys, this was Mr. Neelesh Dhamnaskar. He is the fund manager at Invesco India Mutual Fund, and these were some pretty interesting insights around how the global consumption pattern is changing, the kind of shifts that we have been seeing. Uh, it is one very important takeaway is that while most Indian consumers consume or aspire to consume several leading global consumer brands, most investors don't quite have the access to such brands, and the closest that we can get to it is by investing in certain mutual funds that allow exposure to such brands, or we take the tough route of trying and figuring a way to invest in those stocks directly. There are a variety of international funds available on the Fisdom app. Obviously, the Invesco India Global Consumer Trends Fund is also on the Fisdom app. The fund focuses on international emerging consumer trends, and we spoke about a variety of examples. If you are using Amazon, in fact, I feel all the answers are in your phone itself, right? So if you're using WhatsApp and Instagram, which is owned by Facebook, and if you are shopping via Amazon, and you're using a computer with Nvidia, I feel you pretty much should own a part of the brands that you are consuming, you and the larger population is consuming from. So this was an interesting conversation around international investing and global consumer trends. So these were the key takeaways, and we are going to be back really soon with another interesting episode with an interesting topic for the Fisdom Wealthcast. Watch the space. You can follow us on our social media handles. Follow us on Twitter, Instagram, Facebook, LinkedIn, and YouTube as well. Subscribe to our channel. We will send you regular updates for more upcoming events and more upcoming wealthcasts. So stay tuned. Happy weekend, happy investing over the weekend, and see you guys really, really soon. Do not forget to share this video with your loved ones, hit the like button, and we will continue delivering more such insightful conversations right to you. Thank you. See you around really soon.